Welcome to our Market Deep Dive, covering the first full trading week of 2026, from January 3rd to the 10th. Global equities really kicked off the new year with a strong showing, driven by a noticeable sector rotation, resilient economic data, and a general optimism about policy. Today, we are looking at insights from Reuters, Yahoo Finance, Trading Economics, and various market analysts on X posts.
That's right, Chloe. U.S. markets certainly led the rally. The S&P 500 closed the week up 1.6% at around 6,966, hitting multiple record highs. The Nasdaq Composite was also up, gaining 1.9% to roughly 23,671. But the Dow Jones stood out as the strongest performer, climbing 2.3% to about 49,504, clearly signaling a rotation into value in cyclical stocks.
It's interesting to see the Dow leading, especially after what we've seen in recent years with megatech dominating. So this suggests a broader participation in the rally beyond just those big tech names.
Precisely. The rotation favored industrials, materials, and small caps, which outperformed the megatech sector. Internationally, the markets were also solid, though with varying degrees of strength. The FTSE 100 in the UK briefly topped 10,000 for the first time ever, which is a significant milestone. The Nikkei G25 in Japan also saw positive gains, but it lagged behind the rapid pace of the US market.
Beyond the stock performance, what were the key economic signals we saw? I noticed the December jobs report was mentioned, which often has a big impact on market sentiment and Fed expectations.
The U.S. labor data was definitely a focal point. Non-farm payrolls in December came in at an increase of about 50,000, which was actually below expectations. However, the unemployment rate fell to 4.4%. This combination signaled a steady but cooling labor market. This data largely reinforced views of a soft landing for the economy and has led to expectations for 1 to 2 Fed rate cuts later in 2026. Other releases, like PMI signals, were mixed but didn't cause any major disruptions.
So a cooling but not collapsing labor market, which gives the Fed some room. What about corporate and policy news impacting the markets during this period?
CES 2026 was a major event, highlighting continued strong demand for AI and chip technologies, which resulted in surges for companies like Broadcom and Intel. On the policy front, proposed actions from the Trump administration garnered attention. Plans for $200 billion in mortgage bond purchases were floated to help lower housing costs, while a proposed $1.5 trillion military budget significantly boosted defense stocks. Geopolitically, the U.S. capture of Venezuela's Maduro added an oil risk premium, but markets mostly shrugged this off without a major spike in prices. Looking ahead, Q4 earnings season is just around the corner, and a potential Supreme Court ruling on tariffs is also on the radar.
It seems markets were quite resilient, even with that geopolitical news. You mentioned the sector rotation earlier. Can you elaborate on which specific sectors and market movers were particularly strong, and what themes drove them?
Absolutely. The strong performers included industrials, materials, and home builders like Home Depot and D.R. Horton. Defense stocks also saw a boost due to the proposed military budget. This shift away from pure tech and into cyclicals and value sectors was a defining trend. The top themes emerging were AI infrastructure, continuing the AI momentum from last year, and real assets, with commodities seen as a way to hedge against inflation.
That makes sense. What was happening in the crypto and commodities markets during this week?
Bitcoin remained volatile, trading between approximately $90,600 and $91,000. It showed early strength but was slightly down by the end of the week. Ethereum held steady around $3,100. The total crypto market capitalization stood at about $3.08 trillion, with altcoins seeing mixed performance, but Bitcoin maintained high dominance. In commodities, gold continued its strong carryover from 2025, trading near record highs above $4,400. Oil prices were mixed amid geopolitical risks, but we didn't see a major spike despite the Venezuela news.
So, while equities were largely bullish, there were certainly areas of volatility and caution. As we look to the next week, what are the key opportunities and emerging risks investors should be mindful of?
For opportunities, we could see January effect inflows continuing to broaden the rally, and AI earnings momentum is something to watch closely. However, there are notable risks. Potential Supreme Court rulings on tariffs could introduce uncertainty, there's always the concern of sticky inflation, and geopolitics, particularly in Venezuela and the Middle East, remain background noise. Elevated market valuations are also a point of caution for some analysts.
It sounds like a generally positive start to the year for equities, but with clear headwinds to monitor. The sentiment snapshot suggests a bullish tone on U.S. records and sector rotation, yet with an undercurrent of caution regarding tariffs and potential volatility. It's a complex picture of market resilience despite headlines, with the focus now shifting to earnings and policy clarity ahead.
This conversation covered the strong start to 2026 for global equities, the significant sector rotations, key economic indicators, and important policy decisions from the first week of January, drawing on analysis from Reuters, Yahoo Finance, Trading Economics, and market analysts. If you found this discussion insightful, share this episode with someone who'd appreciate the deep dive.